Hi everyone, welcome again to the next episode of CFA Technical Series in which we are talking about fixed income portfolio management. This is part 2. Remember, CFA Level 3 deep understanding of the subject is important, and my efforts here are to make you understand all the practical realities on the fixed income side. Now in this episode we are going to talk about bond liquidity and how do you break up the returns of a fixed income portfolio. Liquidity in the bond markets is very different from liquidity in the stock markets, and sometimes even with the good credit quality you end up with some parts of the portfolio which are highly illiquid and which is undesirable. So let's explore more here. So now let's revise the concept of bond liquidity, which is very important because the liquidity of fixed income asset classes are relatively different versus the liquidity of the stock market. So it's important to understand how the trading in the fixed income market happens and how the market functions to understand the concept of bond liquidity. Once you understand the functioning, then it is very easy and there is no complex mechanism here. So on the one side here we have corporates who issue bonds or borrow money from the markets through issuance of various type of fixed income bonds on a regular basis. Okay, so they approach the markets whenever required and raise money from the market. Now once a issue is listed in the markets, then it starts getting traded, and which is where the traders and investors start participating in the markets. Now each corporate, let's take an example of a corporate, let's say a corporate in Russia, Russian Railways. It has a mix of bonds issued in the market, various kind of bonds. So one can be a 2-year maturity bond, one can be 3-year, even the currencies can be different. So it will have a fixed capital structure. Now each of these bonds are issued at different dates, right? Which means that the liquidity of these bonds will differ because they have been issued on different dates. Now how the trading generally happens is, there are a lot of fixed income dealers in the market whose job is nothing but to have the inventory of the traded fixed income bonds in the market. So they both buy and they both sell to the market. So they can buy from traders and investors, and they can also sell to traders and investors, and what they earn is a bid ask spread. Now how does this bid ask spread functions in terms of liquidity? So one is definitely, remember, a corporate which issues a bond, the more recent bonds will have a higher liquidity in the market, because once the bond is issued, then typically there are two kinds of traders or investors in the market. One is buy and hold. So people will buy and hold the corporate bonds till they are matured. Then there are traders who actually trade in the fixed income markets and make money from spreads and yields, right? So with both these kinds of participants in the market, buy and hold investors will hold an inventory. So let's say a corporate bond issued 3 year back, or let's say a 7-year bond which was issued 3 year back. It might be an attractive bond to buy for a buy and hold investor, and therefore this investor might hold a chunk of the bond in its portfolio. Therefore what it means is, there is no that proportion of bond available in the market for trading purposes. So what do we conclude on the bond liquidity side? Let's come to some specific conclusions. So the conclusions that we draw from the liquidity dynamics of the fixed income market is, number one, any recently issued bond, which is typically called as on the run bond, will have a higher liquidity versus a bond which has been issued at a later date. So that is very clear. Second is, high quality bonds will command a higher liquidity. Now bonds with a lower credit rating, let's say B rating or double B rating, will have a lower liquidity versus the IG bonds, because the dealers don't stock very less quality bonds because they think that they might not be able to clear that inventory. Also, the bid ask spreads you would see on the low quality bonds will be very high versus high quality bonds. Third is sovereign bonds will have a higher liquidity versus corporate bonds. Two reasons mainly. One is higher volume in the fixed income market. Number two, they are of a higher quality. Right? Again, within corporate bonds, investment grade will have a higher liquidity versus a high yield bond. Now let's talk about the effect of liquidity on bond portfolio management, which is where the level 3 curriculum specifically focuses on. And you can expect some essay level questions from this section. Therefore, it is important to understand what are the difficulties that you can face in bond portfolio management when the liquidity is a concern, right? So number one, pricing data. So remember, fixed income pricing data is different from the equity prices. You would find equity prices very easily on various portals. But most of this in the fixed income market, the bonds trade over the counter, and past price and value information is typically not reported very clearly. Of course, this is becoming much more better in few markets. Now, in the absence of such reporting, or let's say with infrequent trading of a bond issue, how do you factor in the pricing in the bond portfolio management? Let's say you have to send a report to your investors quarterly, but there are a couple of bonds in your portfolio which are not traded on a regular basis, and therefore you do not have a pricing data. How do you compute the various metrics of the portfolio in terms of the return, in terms of the risk metrics like Sharpe ratio, etc.? How do you do that? For that, you have to price the each bonds which are not traded, right? Therefore, if you remember from level 1 curriculum, there is a concept called matrix pricing in the fixed income markets. So matrix pricing is nothing but more, you can compare that to a relative valuation on the equity side, wherein a bond which is not traded is compared to a bond which is traded, and certain adjustments are made to determine the pricing for the bond which is not traded. Now, what are the factors that you typically compare? So there could be features of the bond like maturity, coupon. There could be other things like quality of the bond, so the ratings of the bonds. I can't compare a triple B rated bond with a B rated bond in order to determine the matrix pricing. Because remember, when you are identifying or calculating the matrix pricing, the idea is to select as close comparables as possible. Because if you select close comparables, then the adjustments that you need to make will decline, and therefore the predictive ability of the model will increase. But when you have very distant comparables, the adjustments that you make will be high, and therefore the predictive ability of the model can be a question mark. Correct? So this is what is the matrix pricing, and very important concept in the fixed income market. Now let's come to the second point, which is portfolio construction. So as I told you earlier, there are two kinds of investors in the fixed income market. Number one, buy and hold, and number two are the traders. Now, buy and hold investors, they are okay to buy the less liquid bonds provided they are okay with the credit quality, and hold these bonds till the maturity. Now, what these kind of investors do is they typically are okay with taking a higher yield and earning a higher yield for the less liquid bonds. But for the traders, they will have a very short-term horizon and a short-term trading strategy on the bond side, and therefore they would not take any position in the bonds where they feel that it would be difficult for them to sell at a later stage or settle the transaction at a later stage. Therefore, as a dealer, when you are dealing in the less liquid bonds, you always have to you also always have to adjust for a bid-ask spread for the liquidity. Now, as a dealer, I would be afraid, or I would be nervous of purchasing a less liquid bond because it might take me longer to resell them, and of course there is a cost involved. Now in case I have to, let's say sometimes a few less liquid bonds are popular just because of certain things going around with the company, or certain things happening on the market. In those cases, I might, as a dealer, I might have a bond inventory for those kind of less liquid bonds, but I will charge a higher bid ask spread to anybody I am dealing with, either on the buy side or on the sell side transaction. So the first income that you can think of in the fixed income portfolio is the income yield, which is nothing but what you earn from the coupon that you receive, the interest income that you receive from holding the bond. So in this case, the interest is 3%, which means on an investment of 100, you would receive 3 rupees as the coupon, and the current price of the bond is 101.5. So divided by 101.5, which will give you the current income yield of the bond, which is around 2.95%. So remember here, don't divide it by 100, divide it by the current market price, because ultimately you are purchasing the bond at this price, irrespective of the fact that its par value is 100. Right? So this is the income yield that you generate, or a coupon as a percentage of the market price that you are earning. Now here the coupon is paid semi-annually, but we have assumed that there is no reinvestment of the semi-annual coupon, and therefore this is fine. If you assume a reinvestment, then the half of 3 which you will earn after 6 months will have to be reinvested and will earn a reinvestment rate of return also. Now the second component of the return which you earn is what is called as roll down return in fixed income. And this is very important because what this assumes is that the yield curve is remaining unchanged, and therefore any bond, let's say you purchased a 5-year bond at year 0, after 1 year this 5-year bond will be a 4-year bond, right? And therefore when you are pricing this 4-year bond, you will have to assume a 4-year YTM to price this bond. Therefore this roll down return assumes that the yield curve is unchanged, and based on that unchanged yield curve, what is the extra rate of return that you have earned because of the slope of the yield curve. So the formula to calculate roll down return is the projected price at the end of 1 year, projected price at the end of 1 year, provided the yield curve is unchanged, minus the beginning price of the bond divided by the beginning price of the bond. So here the projected price, if you see here, it is if the yield curve is unchanged, is 102.4 minus the beginning price, the price at which it was purchased, which is 101.5 divided by 101.5. This should come to roughly around 0.905%. Now the third kind of return is the expected change in yield return. So remember, the yield curve, in order to tell someone that the yield curve will be unchanged is impractical. So the yield curve is going to change, and therefore we have to model how the change in the yield will impact the change in the bond portfolio return. So we call this as expected price change because of change in yield. Now how do we calculate this? So this is based on a yield change will impact the bond portfolio in 2 ways. So remember the formula that was used in level 1, which you might recall, is minus modified duration into change in yield into half into convexity into change in yield whole square. Right, so this is a formula which we have used a lot to calculate the expected price change because of the change in yield. And the inputs that you require here is number one, the modified duration, and number two, the convexity. Right, so based on the modified duration given here and the convexity given here, we can calculate this, and this should come to around 3.024%. You have to remember this formula, and this formula is primarily driven by this first part, which is nothing but that change in yield will impact different bond portfolio in different ways, and therefore when you see that as a portfolio manager you are expecting change in yield to be favorable for your bond portfolio, then you try to increase the modified duration, and otherwise the convexity part will have very less impact for the option free bonds. And remember, convexity is nothing but a second order effect and not a first order effect, so it will have a very less impact on, especially on the option free bonds, unless the change in yield is very high. Now the fourth kind of return on the fixed income portfolio is the credit losses. So before we move on to the fourth one, recall the first three ones. So what were the first three ones? Number one was basically the main return, or I would call a bread and butter return, which is nothing but the income yield which you earn by holding the bond. Second is what you earn as a roll down return, which is because the yield curve is a sloped yield curve, and you will earn a return by holding the bonds to a certain level and then selling the bonds and then again reinvesting into a similar kind of maturity bond. The third was the expected change in yield, right? So change in yield return. These are the three traditional returns which you earn on the fixed income bond portfolio. Now the fourth kind of return could be a credit losses that you can incur, primarily because you invested in an instrument which has defaulted or which was of a lower quality, right? So in this segment it is primarily a simple logic in terms of probability of default and loss given default. So you have to take an assumption in terms of what is the probability of default of that the entire bond will default. And here, for example, let's say we have assumed that 0.07% is the probability, and what could be the loss given default if there is a default. So it is expected that 85% of the entire bond will be wiped out when the company defaults. So 0.85. So like that ways you can calculate the credit losses of the portfolio. Here in this case it would be somewhere around 0.06%. So remember, when we are discussing fourth one, we are more coming on to the quality of the issues, etc., and not talking about the yield curve or the market related changes. Now in terms of the fifth one, so the fifth one is nothing but the currency impact of the overall bond portfolio. As a fund manager, you might not just invest in your domestic currency bonds, but you might also invest in the foreign currency bonds, and therefore it is important to factor in the currency movements. Any adverse currency movement can impact your portfolio returns negatively, and otherwise vice versa also. So here in this case we have assumed that the expected appreciation of foreign currency is 3.925%, and the percentage of foreign currency bonds in the portfolio is 40%. So the positive currency impact because of this would be the expected appreciation of the foreign currency multiplied by the percentage you have in portfolio. An example that I can give is a US fund manager invest in the Indian markets in INR. Why? Because the yield in the sovereign bonds is higher versus the US. Therefore, he wants to earn a higher return. But he has to take care into consideration that the INR is not depreciating. If there is a expectation that INR will depreciate, then he has to hedge his losses. But here in this case, if INR is appreciating, then he will earn this extra return from the appreciation of INR.